Hello and welcome to SCN Corporate Connect. I'm Jane King at the NASDAQ market site in Times Square. And with me today, Mauricio Raoult, Managing Partner at Four Peaks Capital Partners. Welcome.
Thanks for having me, Jane.
So Four Peaks specifically invests in mobile home parks. Why do you see an opportunity there?
Yeah, we're actually an investment firm, and we actually invest in alternative assets. And real estate's obviously one of our favorites. But we've actually looked at all of the real estate opportunities in multifamily, retail, single-family homes, and oddly enough, mobile home parks is where we find the opportunities right now. There's really three reasons why we like mobile home parks. First of all, it's real estate, right? So all the reasons we love real estate, the depreciation, the wealth factor, the leverage, the hedge against inflation, all those still apply to mobile home parks. But number two, they're cash cows. They really are. Most people don't realize that 50% of Americans live on $600 or less a month. We always forget about that. Yeah. And so they're in a situation where below mobile home parks, they're living out of their car, and below that, they're homeless. And so there's a tremendous demand these days for mobile home and affordable housing. The last statistic I saw, I think it was 2009, showed that 50% of the new residents moving into mobile home parks were coming from single family. So there's tremendous demand that's propped up. And with that demand, you would expect a supply to be increasing appropriately, but we're seeing the exact opposite. A lot of the communities don't want to see mobile home communities in their neighborhoods, and so zoning restrictions really are prohibiting the mobile home parks to be built in the communities. In many places, as the cities expand, a lot of the mobile home parks are actually getting sold. Strip malls, developers, and so there's a lot of land banking. So we see the demand, we don't see the supply. So those are really two of the main reasons we like mobile home parks. Expense ratios are really low in mobile home parks. Unlike multifamily, we can actually, with a good operator, we can get a really low expense ratio because we actually sell the mobile homes to our residents. We actually just own the land, and we lease that to the resident. And so they have pride of ownership. They don't tend to move. So there's just a lot of great reasons for mobile home parks.
Well, and the cash flow would be pretty constant as well, right?
Yeah, that's why we call them cash cows.
Yep.
I mean, because of that demand, the cash flow, we're seeing these days, 8 to 12 cap returns on mobile home parks, which compared to the other asset classes is tremendous. We just closed on a park a couple weeks ago that was an 11.5 cap, 90% occupied. So it's really a great asset class. So anyway.
Now, you spoke of the lower income individuals. I mean, is there any foreclosure issues? Is that a higher risk with a mobile home park?
If anything, we see the opposite. We see the asset class being more of a recession-resistant kind of class. And the reason is very simple. Whenever you have a recession, you have all of the A players kind of get knocked down to A-, and the A's get to B's and B's to C's, and you get all the way down to mobile home parks. So during a recession, we actually see an increased demand for our product because, again, people who are at the lower levels don't have anywhere else to fall. Right. So we see a tremendous demand, not only today, but also as we move forward into the next recessions we see coming.
Now, I assume it would have the same tax benefits that you would get with any real estate investment.
Absolutely. Tax benefits are one of the nice things about real estate in general, but with mobile home parks specifically. So the same depreciation benefits you're getting in multifamily, you're getting them in mobile home parks, but actually you get to accelerate the depreciation a little bit faster. So you're dealing with roads, you're talking with infrastructure, and so instead of waiting the 27.5 years you typically wait for multifamily, you can actually depreciate those much faster.
So Mauricio, Warren Buffett, obviously very savvy investor, is also interested in this space.
Not only is he interested, he's one of the largest players in the space. Through Berkshire, he actually owns 21st Mortgage and Clayton Homes. And 21st Mortgage is the largest lender in the space with over $8 billion, that's billion with a B, of outstanding loans. And interestingly enough, their default rates are really very low, and 3 to 5%. And they also have they have Clayton Homes, which is where they manufacture their brand new homes. And so we're very fortunate to be partnered with Clayton and 21st. And so whenever we have a park where we have an empty lot and we need to bring in a new home, we call Uncle Warren, as we like to say, and they'll put in a brand new home and provide the financing for the resident. Because for the resident, it's all about the monthly payment, right? They can't necessarily afford a $20,000, $30,000, $40,000 home, but they can afford the monthly payment once the lending is in place.
Now, how can somebody find out more about Four Peaks Capital Partners or potentially become an investor?
Yeah, so probably the website's the best place to find us. It's www.fourpeakspartners.com, and just reach out there.
Okay, great. Thank you so much, Mauricio, for joining us today. Very interesting asset class, not one that a lot of people think about. So always good to introduce kind of those alternatives to us. Yeah. So thank you very much.
Thanks for having us.
And thank you as well for joining us. I'm Jane King at the NASDAQ market site in Times Square for SCN Corporate Connect. Have a great day.